UK inflation has now stayed at the same level of 2% for a second month. That is the Bank of England's target. So why are major newspapers describing this as a bad thing? The Guardian claiming progress has stalled. Well, when we look at the official data in a bit more detail, it becomes clear why. Let's start with this overall table. This is CPIH, the H stands for housing. And I look at this table because housing is an important cost to everyone in the UK. It continues to surprise me that the UK media constantly quotes CPI without looking at housing costs, when even the ONS themselves, who measure all of this, focus on CPIH. Some of the biggest declines are being produced by goods. Goods are physical items that we buy and use. We see this reflected in the total goods number here. So a combination of the impact of all of the goods on the inflation data shows that the overall effect on inflation of anything described as a good was negative, minus 1.4%. Most notably, furniture continues to pull down the overall number, albeit at a slightly lower rate than last month. Clothing and footwear has also seen a big decline from 3% to 1.6%. The decline in the increasing rate of the cost of clothing can really be put down to summer sales. For this reason, I tend not to get too excited about this sort of decline, as I don't think it really speaks to the reality that we all feel on the ground. We can't be relying on the next summer sale to drag down the overall rate of inflation, can we? Don't worry about your mortgage, Kevin, because a pack of 3 Easy Care cotton shirts at Next are 30% off. In a similar way, we can point to seasonal impacts forcing inflation up. Restaurant and hotels inflation at 6.3% is a significant upwards climb, as everyone tries to get a little taste of whatever summer it is we have. It also could be the lingering effects of Taylor Swift coming to town. Overall, this is the same picture that I've been harping on about now for months. Service-based inflation here is not moving. In fact, it's risen from 5.9% to 6%. Sticky service-based inflation is a concern in a service-based economy, and it's this service-based inflation that will dictate when the Bank of England eases interest rates. The indicators for when we will see this service inflation fall include wage growth and unemployment. You can see across the pink, blue and yellow lines that the indicators remain pretty flat. Unemployment has ticked up, called the jobless rate here, but the argument is as more people become unemployed and wage growth slows, the pressure on service businesses to put up their prices, whose main cost is people, will fall. You might say, first of all, then, that it's to be expected that service-based inflation will take longer to come down than, say, goods inflation, because as the costs of goods rose and we had shocks to items like food and energy, then that leads to demand for higher wages, which cause the prices of services to go up. A sort of knock-on effect, if you will. Energy, COVID, money printing, these things were like a big brick thrown into the economic pond, and service-based inflation is one of the later ripple effects of that. I actually think, though, a lot of the service-based inflation wasn't due to wage demands, but more the after effects of lockdown as businesses tried to recoup profits that they'd lost throughout that period. I think this thing of wages go up and that leads to higher services is very oversimplified. But regardless of the cause, the persistence of service-based inflation at 6% is a problem. Even the IMF are commenting on it at this point. So where do we think inflation overall is going from here? On screen is the 12 months that make up the latest annual inflation figure. Think of it like a conveyor belt. As we get new months data at this end, this data falls off at this end. It's the total impact of all 12 months data that produces the overall number for inflation. We had quite big overall declines in January and July 2023. If next month, when we get July's data, we're not seeing this sort of decline again or more, well then the inflation number will go up because the downwards pressure of this month exerts on the total number will fall away. The Bank of England every 3 months releases their monetary policy report that looks at the state of the UK economy, but also makes projections and predictions on the direction of inflation. This chart gives a nice overview. So the greeny blue line shows CPI inflation, that's the headline rate without housing costs. The orange is CPI excluding energy, and the purple bars at the bottom are the impact of energy costs on inflation. This period here where the purple bars are high is when everyone's energy costs went crazy. Then here, the purple bars declining below the zero are the falling of energy prices that we've seen recently. Notice the green line, which includes the impact of energy on inflation, spikes significantly above the orange line here and below the orange line here. This is the energy price's overall impact on the inflation figure. So look at the current period then, where the green line, with energy included, sits at the 2% level, the Bank of England's target, but it's been dragged down by the energy bars being below zero. The declines in energy prices are pulling us towards the 2% target, but when you strip out energy, inflation is above that target. We can see this impact in the official data from the ONS, who have core CPI inflation without food and energy costs at 3.5%. The Bank of England then show how they think inflation will bounce back as energy costs stop declining and dragging down the average number. The forecast here suggests not really until late 2025 will we see sustained 2% inflation. This overall flattering effect of energy on the recent numbers is clearest to see when we look at the housing costs again. We see this massive spike in energy costs and what they did to the overall cost of running a home. We can see now the decline or fall away of those same costs. But this rise here in rents and owner-occupier housing costs, the main one being mortgage interest, is a result of the actions that the Bank of England has taken to combat inflation through rising interest rates. This increase of housing costs is a side effect or even the desired effect of the cure for inflation. The Bank of England increases interest rates to stop people spending by making housing, amongst other things, more expensive to maintain. Owner-occupier housing cost inflation sits at 6.8% a year. This is currently the highest rate since 1992. That was a period of time where people were being repossessed en masse. A different time and a different set of circumstances, I get that, but I just think it speaks to the fact that for many, the real inflation story, the real thing hurting everyone is not hotels or transport or education, but just simply maintaining a roof over their heads. If you do not own a property outright at the minute, you are exposed to this sort of inflation. This part of the inflation mix and the pressure it exerts on households will really only get meaningfully better when the Bank of England reduces interest rates, or if wage growth rises above the rate of inflation so people's spending power improves. But as I've already pointed out, wage growth is something that the Bank of England wants to see reduced to see service-based inflation decline. It is possible that wages continue to grow above the rate of inflation though overall. But just to echo the sentiment of previous videos I've done on this topic, anyone expecting dramatic rate cuts back down to 0%, it's highly unlikely that that will happen. If you look at 100 years of interest rates in the UK, the average over that time period is about 8.3%. Since the 60s, more modern history, it's about 5.9%. I think long-term rates at 3-4%, that kind of range is more likely. I personally think it's unlikely that we'll see a rate cut at the next monetary policy meeting on the 1st of August, but that is half a month away, so maybe the Bank of England will get a view on the next set of data or know something that we don't by then. Currently, the market seems to be forecasting the probability of a rate cut in August at around 45%. Previously, it was around 60%, so they've slashed that forecast. I'm no economist, but I would be surprised if we saw a decline prior to the service numbers moving in the right direction. But don't listen to me. Let's listen to the people who actually make the decision. Catherine Mann is a member of the committee who decide on the Bank of England rates. Until I see sustained acceleration in the service prices, I'm not really in a position to cut rates. Hugh Pill is another member of the committee, and he said underlying inflation was proving persistent and possibly permanently harder to control. Permanently harder is a nod to the fact that it may take years to get these service numbers under control properly. I think rate cuts will happen before then, I just want to be clear on that, but I think they'll be done tentatively with a close eye on the effects on the service numbers. I think this whole pretty much 50-50 flip of a coin, we don't know what's going to happen, speaks to how, very much we're still on a knife edge with these service numbers, and I don't think anyone, not even the Monetary Policy Committee, know what the best thing to do is right now.